Hi, this is Ratan Gupta from Knowledge Varsity. Welcome to today's reading on debt securities. We are covering reading number 60, features of debt securities. Okay. This content is brought to you by Knowledge Varsity. We conduct live and online classes for CFA program. So in this reading, we'll be discussing about what are the different type of bonds and their features. Okay. So whenever like a company issues a bond, it issues a contract. In that contract, it specifies the right and obligation of both the issuer and the holder. Okay. So this contract is called as indenture. Okay. Now there are some restrictions on the issuers, okay, which are specified in this indentures. So there are restrictions as well as obligations. These are called as covenants. The covenants can be both affirmative and negative. Okay. The affirmative covenants are the covenants that the borrowers say that it will perform. Okay, so these are borrowers conditions that they have to provide this. Okay, some of these are like maintenance of financial ratios, that is they have to maintain this debt to equity ratio or interest coverage ratio. These are the affirmative covenants. Similarly, there are some negative covenants, that is they are providing some restriction on the borrower, restriction or prohibition on the borrower. These are like you cannot sell some asset, you cannot borrow above some limit. So these are the negative covenants. Okay. Now each of the bond that is being issued, they have these covenants or indenture. Okay. Now we'll see like what are the different type of bonds. Before covering the different type of bonds, we'll cover like what a bond has. A bond has what is called as coupon. Okay. It has a coupon, it has a face value, it has a time to maturity, that is like at what time the bond will mature, that is it will cease to exist. Okay. So as we saw in time value of money, you can find out the present value of the bond and then you will have the price. Okay. So bond has coupon, face value, time to maturity, price. Okay. Depending on how these are structured, you can have infinite bond types. Okay. The simplest type of bond is straight bond or called as plain vanilla bond. Okay. So this straight bond has coupon, it regularly pays coupon. The coupon can be paid annually, semi-annually, monthly. It has a face value, it has certain time to maturity. Okay. Okay, it is simplest type of bond. Okay. Then next you have zero coupon bond. Okay. By the name it suggests that the coupon of this bond is zero. So this coupon is zero for this bond. Okay. Now these bonds are also called as discount bonds because these bonds are issued to the investor at a discount to the face value. So let's say if the face value of a bond, of a zero coupon bond is $100, it would be issued at a price which is lesser than this 100. So it can be issued at $70. Okay. So what happens is at the time of maturity, the investor or the bond holder will get $100. So he invested $70, he will get $100 from his investment. So the earning that will be there will be $30, and that will be the interest that the investor has received. Okay. Another type of bond is step up note. Okay. In this what happens is the coupon rate will be increased. It can happen once, it can happen more than once. Okay. But there is an increase in the coupon rate. Okay. There are some bonds which do not pay coupon for a specified period of time, that is they are called as deferred coupon bond. So it is a combination of zero coupon and a straight bond. What happens is for a certain number of years, so if the bond is for let's say 10 years, for let's say for 3 years it will not pay any coupon, and after the at the end of the third year or fourth year it will pay all the coupon at bulk. Okay, so that is a bullet payment it will do. And the coupon which are deferred will be compounded, that is interest rate will be charged on those coupon which have been missed. Okay, after the payment of those deferred coupon, the bond will start behaving like a straight bond. So from here it will start behaving like a straight bond. Okay, then there are a category of bond which are floating rate bond. Here, like if you see, straight bond had a fixed coupon. The coupon was not changing. Zero coupon bond did not have any coupon. Step up note used to increase the coupon at some point. But the floating rate bonds are those bonds in which the rate is not fixed but it is floating. We'll see the category of this bond. So these bonds are also called as floaters. Okay, there is usually a reference rate on which the floating rate is decided. Usually it is LIBOR, that is London Interbank Offered Rate, is used as the reference rate. The coupon rate for the bond is this reference rate plus or minus a margin or the markup on that. So if the LIBOR is 5% at one point of time and the margin is 0.5%, okay, so the coupon rate for that period would be 5.5%. Okay, now this LIBOR can change. So if the LIBOR changes from 5% to 6%, the coupon will be this 6% plus this 6.5%. The coupon will become 6.5%. Okay, so the coupon rate is floating or is changing depending on the reference rate. So the reference rate has changed from 5 to 6, the coupon has changed from 5.5 to 6.5. For some investors, it can be, margin can be reduced from the reference rate also. Okay, in this case what was happening was the rate was increasing, reference rate was increasing, the coupon rate is increasing. But we can have floating rate bonds which are inverse, that is if interest rate increases, the coupon rate is actually decreasing. So in that case the coupon rate can be stated like this, 10% minus the reference rate. Okay, so the coupon rate is 10% minus the reference rate. So when the reference rate was 5%, the coupon rate was 5%, 10 minus 5. But when reference rate becomes 6%, the coupon rate has become 4%. Okay, so here the coupon is decreasing when the reference rate is increasing. It might happen that the reference rate can become 10%. In that case the coupon rate will be 0%. Or it can happen that the reference rate can exceed 10%, coupon rate can be negative. Usually that does not happen, but companies or the issuers or the bond holders, they agree upon that interest rate cannot become negative. There is another way to agree upon some specifying some interest rate, and that is through agreeing on what is called as cap rate and floor rate. Okay, so a company, an issuer can issue a bond and specify that the cap rate is 8%. That is, the coupon rate in no case can become more than 8%. So in this case, if the reference rate become, let's say 9%, so the coupon rate should have been 9.5%. But if the issuer has specified that there is a cap on the rate of 8%, that is a cap on the coupon to be 8%, coupon cannot become 9.5%. It has to be 8% only. So a issuer can specify a cap rate. This cap rate is helpful for is benefiting the issuer, right? Because if the rate had become 10%, he should have been paying 10.5%, but it is only paying 8%. So cap is benefiting issuer, but it is against the interest of the bond holder. Okay. Similarly, you have one more thing as floor rate. That means if the coupon rate has become, let's say 1%, okay, so in that case the interest that is to be paid, that the coupon to be paid by the holder is 1.5 by the issuer is 1.5%. But a borrower can specify that I do not want any coupon below 4%. So he is specifying a floor rate on the bond. So this is the floor rate, that is coupon cannot be below 4%. Okay, so a bond can have floor and it will benefit the holder, but it will be against the issuer. A bond can have both of these, and combination of both of these is called as collar. That is, you can have a cap as well as you can have a floor. Okay. Now there are some bonds which are linked to the interest, linked to the inflation rate. So these are called as inflation indexed bond. Okay. These are linked to the consumer price index. The inflation is being calculated from this consumer price index. Okay, now the bonds can be traded in the market. Okay, so when they are trading in the market, there has to be some price for it. Okay, there are, depending on the way the bond price is quoted, it can be deemed as a full price bond or a clean price. Okay, so let's first see what are these prices and how these come. So let's take a 2-year bond, okay, paying annual coupon of 10% and a face value of 100. Okay, so it pays a coupon of $10 and then a face value of $100, okay, in the next year. Okay, suppose some person bought the bond at time t equal to 0 and it want to exit the bond after half year. So that is after 0.5 time period he want to exit the bond. Okay, so he should be getting the interest that is accrued on the bond over this 6 months. Okay. Okay, so if a bond is traded considering the accrued interest over this period, it is called as the full price. Okay, so this period rate is called as accrued interest. Okay, a bond which is traded considering this accrued interest, it is called as full price. If a bond is traded without considering this accrued interest, it is called as clean price. Okay, I am saying that traded, that is the price that you will see on the exchange or on the quotes. Definitely it is sure that the person who is buying the bond will have to pay accrued interest to the seller, because the buyer will get the bond on this day. Okay, it is not the seller who will get this $10. So but the buyer is only entitled for the interest that is for this period, which is $5. So he should give back the $5 to the seller. So the price should include the accrued interest. But usually what happens is, in US, in the exchange, the quotation that the bond dealers give are the clean price, because it is very easy to find out. If you want to price the bond at this point of time, what you will do is you will discount this $10 at whatever is the interest rate for half year, and you will discount again the $110, okay, for 1.5 year. So you will say that is the present value of the bond, or this will be also the clean price of the bond. Okay, and on top of that, whenever the trade happens, they will add accrued interest to come up with the full price of the bond. Okay. Okay, sometimes there are bonds which will pay interest as well as principal regularly. These bonds are called as amortizing bond. Most of the consumer loans are amortizing bonds. Okay. Similarly, there are like bonds which will pay only the coupons and the principal will be paid at the end, okay, on maturity. These are the non-amortizing bond. Okay. Now when investors have invested in the bond, that is they have bought the bond, they will be interested in redeeming the bond. Usually the redemption is done at the maturity, but then there are some situations where redemptions are done before. Okay, and there are also cases where some part of the money is paid before the maturity. Okay, so these prepayment options can be on both the bond investor or the bond issuer. Okay, So these are the prepayment option, that is option to prepay before the maturity date. Okay, there is a provision called as call provision. Okay, this call provision, this gives the right to the bond issuer to call back the bond, or in other words I can say pay the investor the money before the maturity date. Okay, so he has the right to call the bond. Okay, usually this call there are call prices as well as the dates that have been decided, that okay, after issue the call price will be 105, after 1 year the call price will be 104, after 3 years the call price will be 102, like that. Okay, there is also a call protection period, that is it specifies that within 1 year there will be no bonds will not be called. Okay, within 5 years the bonds will not be called. This is to protect the bond holders. Okay, because if a company has issued a bond and it is calling back the bond, it is paying the money to the investors. The investors had invested in the bond considering that it that they have invested for 5 years, but let's say the issuer call back the bond in 6 months, investors are given back the money. The investors do not know where to invest, that this is an unexpected event for them, so this is a risk for them. Okay, so there is usually a call protection period for the investors. Okay, similar to call provision there is a put provision. This is to the bond holder and he can ask for the payment before the maturity date. Okay, so this benefits the bond holder. Okay, there are some bonds, okay, which are specified as non-refundable bond. Okay, what happens is issuers can call back the bond by issuing another bonds, usually at a lower coupon. So these non-refundable bonds, these prohibit the issuer from calling the bond by issuance of a lower coupon bond issue. Okay, usually what happens is when the interest rate decreases in the market, issuer can issue new bonds at a lower interest rate and it will pay back the money to the bond holders. Okay, and bond holders have the money when the interest rate has declined in the market. Okay, and they are forced to invest at a lower rate. Okay, so to prevent this, these are the options. So this is beneficial for the bond holders. Okay, there are apart from call provision, there is a provision which is given to the bond issuer and it is called a sinking fund provision. In this provision the bond issuer can retire some part of the bond at regular interval. Okay, usually yearly. So if a issuer has issued a bond of face value, let's say $100, and he has issued total of 1 million bond. Okay, so the number of bond issued is 1 million, total issue was $100 million. It can specify in the indenture that every year it will repay 10% of the bond or 100,000 of the bond to the investors. Okay, so at the end of the 10 years, so let's say if it's a 10-year bond, so at the end of the 10 years he has paid back all the bond. Okay, there are two ways to do this. He can directly pay back the investor cash. Okay, when the cash payment is done, the bonds are retired at par, that is the investors are paid the par value. So investors are paid $100. Okay, so now since the price in the market can be different than $100, so it is the issuer's responsibility to find out the investors who will be selected at a random. So what is done is a lottery is done to find out the holders who will be paid the money. Since this is not beneficial to the bond holders, so it is an unfortunate event for them. Okay, so what the bond holder does is bond issuer does is it deposit money to the trustee, and it asks for the trustee to do a lottery and select the investors and pay back them the money. Okay, this is done at par. So if the market rate, if the market rate of the bond is $105, a, a issuer will go for this method because he will pay only $100. When the par is done, he will pay only $100. He will not go by this method when the market rate is 98. Okay, so when the market rate is 98, what he will do is he will purchase the bonds at the market price at 98 and he will deliver the security to the trustee for retirement. Okay, so in this case the bond holders are getting the fair value whatever is there in the market, but in the first case they are not getting the fair value, so they are getting a lesser value than the fair value of 105. Okay, so this is disadvantage to the, so the cash payment is disadvantage to the bond holders. Okay, there is also one more disadvantage, and that is called as accelerated sinking fund provision. This provision, it allows the whole bond issuer to retire more bonds. Okay, what happens is sometimes the bond issuer can generate more profit and they can retire more bond, so they can retire more bond from those profit, and it is negative for the bond holders. Okay, now the redemption price that are there, usually there are some regular redemption price, that is what is specified in the indenture. Okay, but sometimes what happens is due to bankruptcy etc. Okay, the whatever price is specified in the indenture, the bond holders do not get it, so they get what is called a special redemption price, and that is usually lesser because of the asset sales, the money is given to the investors. Okay, now we have seen that there are provisions like sinking fund provision and other provisions which will, through which the bonds can be retired before their maturity date. Okay, so some of these options, so these are embedded options, so some of these options are favorable to the issuers and some of these options are not favorable to the issuers, or they are favorable to the bond holders. So please, this is very important to know which are favorable to the bond issuers and which are favorable to the bond holders. A call gives the right to the bond issuer to call back the bond, so it is favorable to the bond issuer. Prepayment gives the bond issuer the right to pay money before the maturity. Accelerated sinking fund provision gives the right to the issuer to pay the principal much more than what is specified in the indenture. Also a cap, it forces that the bonds coupon cannot go above a specified rate. So all of these are favoring the bond issuer. Okay, usually not usually, this is the case whenever there are options which are favoring the issuers, the interest, the bond yield will be more because the investors require more yield. Okay, so because the investors require more yield from them. Okay, okay. Similarly, whenever there are something which is favoring the bond holders, okay, the yield is lesser because these options are benefiting the bondholders, so they should sacrifice some of the yield. Some of the things which are favorable to the bondholders is, one is conversion option, that is the bond holder can convert the fixed income security to equity security. Okay, and hence when the company is growing, they, because bond is giving them only a fixed part, but when they convert to equity they will be taking part as a shareholder and can take a part in the growth of the company. Okay, put provision, when the bond's price become lesser than what is the put price, they can force the bond issuer to take back at the specified price. Okay, and the floor, That is, if the market interest rate has decreased to 3%, they can say that okay, the floor should be 5%, you cannot pay me less than 5%. Okay. Now we see from the context of institutional investors how they do buying of the bonds. Usually what happens is they buy the security on margin, okay, and they provide the amount that is being provided by the banks. uh, these institutions, they provide bonds as a collateral. Okay. Sometimes what happens is without collateral they will be getting the money. Those securities are posted as collateral. They are being charged some interest rate. So these interest rates are very high. Okay. And these margin amount at which margin percentage at which they are buying the security are regulated by the Fed Reserve. Okay. There is a option to the institutional investor, that is they can purchase the they can get funding through what is called as repurchase agreement. So this agreement or an arrangement is there to, for an institutional investor, what they do is they will be selling the security, not exact they will be selling the security to another investor, another institution. So let's say there are two institution A and B. So what A does is A passes on some bond. Okay. So A has lots of bond. A is in need of money. Okay. A passes all the bond to the let's say worth $110 million to B. Okay. A is in need of $100 million. So what B will give is, B will provide A with $100 million of cash. So B will provide $100 million of cash. Okay, so this is $100 million of cash. A has agreed to purchase back the bond at a later date for a price which is higher. Okay, so what A will say is like, okay, I will buy back the bond. Okay, I will get back the bond. So this bond I will get back and I will pay you money. So this money I will pay you, let's say $100.5 after 1 month. Okay. So what is happening is A gave the bond to B or sold the bond to B and got some money. Second step is A gave B an amount which is higher than this amount and got its bond back. So this amount 0.5 is the difference, is the interest that B has received from A for 1 month. The benefit of repo agreement is that it lowers the cost of funding because B is already holding bonds of A as collateral. Since this is collateralized, risk of B is lesser and hence it is able to provide at a lower cost to A, funding at a lower cost to A. Most of the institutional investors, they do not go with margin money, but they will go in for repo. Okay, there is, if repo is done for overnight, it is called as overnight repo, that is only 1 day repo. But usually repos can be done for more days, 7 days, 14 days, 1 month, etc. They are called as term repo. This agreement is for a specified period of time. Overnight repo and term repo are very much present in the market, and it's a good source of funding for the institutions. Okay. So we have covered reading 60. Hope you enjoyed the session. Thanks.